President Trump's tough talk on trade and tariffs may be a boon for business. A recent study from UBS shows 71% of business owners polled actually want more tariffs on China. This is just the tip of the iceberg. Joining us right now is UBS Wealth Management Head and Chief Investment Officer, Mike Ryan. Mike, it's great to see you.
Good to see you, too, again.
Thanks so much for joining us. Tell us what you came away with from this study.
Well, my principal takeaway is that, while we're certainly seeing some concerns about trade, it's certainly not the top thing for business owners. In fact, the things they're more focused on right now are the ongoing impact of tax reform and also regulatory relief, and that's certainly providing benefit. In fact, some companies are actually seeing some benefit from the higher tariffs. It's giving a little more pricing power, and certainly in an environment where pricing power has been difficult to come by, that's providing some relief for some companies.
So what was the makeup of these businesses that said that? Small, mid-cap, large? Because that also weighs into it, right?
Yeah, these are very small businesses.
So
these are small business owners. Okay. And basically what they told us was two things. One is that this isn't negatively impacting their plans on either spending or hiring. They continue to focus on business expansion. And that only a very few are seeing a negative impact that's going to in any way either influence their hiring plans or their expansion plans.
But the business owners are still concerned, and they're more concerned than investors. So you're seeing investors still put money into the equity markets. They're not moving to the bond funds. So how do you dissect that, the difference between the two?
So the way I dissect it is that when you think about it from a business owner's perspective, what they still have to focus on is that down the road, there's still repercussions for the second-order effects of trade. Remember, right now we're seeing is the initial impact, but then we always know there's second-order effects. So there's obviously keeping in the peripheral vision, okay, if we see a further escalation and if we see a response by China, what could that mean for some of the business owners here? Now, remember, a lot of these smaller business owners tend to be more domestically focused, so they're a bit more insulated. But their concerns is that if it raises input prices for them, that creates a real negative for them.
So we just fleshed up a marker that 56% of the investors that you surveyed were worried about national debt. Tell us more about where that registers. We're looking at trillion-dollar budget deficits for the next few years. Is that a concern for the business owners? And, you know, for investors, how is that affecting their behavior? They say it's a concern, but how is it changing the way they're managing their money?
Well, it's interesting when you talk to business owners, John. The thing they're most concerned about is healthcare costs, not surprisingly, because it's an input for them. And they're also concerned about issues of cybersecurity because they're increasingly seeing threats there. When you talk to investors, the things they're most focused on is the dynamics in D.C. and also this concern about the deficit. Remember, what's different right now is we're actually seeing the deficit rising at a point where we have a very, very healthy economy, when the unemployment rate's low, when GDP is strong, and that's atypical. Normally, at this point of the business cycle, you typically see deficits falling or even moving into surplus.
You're saving up for the future when the next downturn hits.
Yeah, so we are seeing the impact of certainly the tax cuts, but also of some of the receding of some of the spending cuts. Remember, we had gone through sequestration that had expired, and we've seen some increase because of this budget agreement, another $300 billion in incremental spending that was agreed to by Congress.
But investors don't seem, they say they're worried about it, but stocks are hitting new highs and bond yields are pretty low. It doesn't look like they're actually acting on that concern.
I think they think he's in a negotiation.
Yeah, well, in terms of trade, I completely agree with you. It's a negotiation, Maria, and they're certainly not focused on that. And they see this as the end game being a broader opening up of China's markets. They see it as creating a more level playing field for U.S.-based corporations. I think in terms of the issues, though, on the deficit, I think investors are not focused on it near term because they don't see this as an immediate impact. But I do think what you are starting to hear is more concern about what this could mean over the next 3 to 5 year horizon.
But in terms of the tariffs that have gone into effect, this survey happened when there really haven't. The tariffs have been in effect a matter of months, if not weeks, because the steel and aluminum tariffs started in spring, and then we had the initial tranche of $34 billion in goods imported from China and reverse that were, and then also the retaliation from some of our allies. But in terms, of course, they wouldn't see that big of an economic impact. It's really a case-by-case basis of, say, steel companies that use steel that are trying to get tariff waivers from this administration and can't, that have been turned down. So I'm just saying that this reflects the fact that in terms of the total dollar amount of goods that tariffs have been slapped on, it's not big enough for people to really be, for the broad economy to be hurt by it.
Yeah, I agree with that. First of all, it's not big enough and certainly haven't been in place long enough to hit a pain point. And as you rightly point out, there's another potential $200 billion that we're right now going through this process of businesses can comment on through the end of August, and then we'll see if that gets implemented or not. So obviously there's other iterations of this, and there's more to follow through. And that's why you hear business owners still expressing concern about this could still be a negative for the economy as you start to go a little bit longer.
So when is going to be, do you think, that cutoff date if we still don't have a trade deal in place, aside from South Korea, that investors start worrying? Because we keep hearing from the administration, Mexico's close, we're going to see a deal with Mexico, EU is close, but until we actually have a solid deal, you don't have that clarity.
I think what would be really, from an investor standpoint, would provide some validation that these are temporary and they're transitory and they're not permanent trade issues, is that if we were to see a negotiation entered into and finally an agreement reached with Mexico and also with Canada.
That would be a big positive.
Well, it's a positive because they're our two biggest trading partners. Right. If you think about the global logistics chain and how dependent U.S. businesses are, they're certainly more dependent in terms of inputs from Mexico or Canada than they are from China.
But the president talks about in one moment that this is a negotiation, but then crows about paying down some of the national debt with these tariffs. He said it on Twitter again over the weekend.
That's just wrong.
Well, I said it's astonishing to have a Republican in the White House bragging about a tax increase on the American people. I just thought, so again, it's not, it's a negotiation maybe, but he's clearly happy what these steel tariffs are doing for the steel industry. And then we don't talk as much about what the impact is on steel consumers in this country.
That point, we're running trillion-dollar deficits. The idea that these tariffs are going to help us pay down the debt is just mathematically impossible. I mean, we have trillion-dollar deficits. That's just
it's just not enough money that you're going to get from tariffs.
No, we're building up we're increasing national debt. We're not paying it down. Yeah, we're not anywhere near paying it down.
Yeah, I think to John's point, I think it's more about messaging than it is in terms of material impact. Because on a $20 trillion economy with $1 trillion deficits, what we're talking about in terms of steel tariffs or other tariffs just aren't big enough to make a big dent in the deficit. And by the way, they don't go into the national account. They actually, a lot of this goes to the benefits of business owners, ultimately. So to me, I think what we will focus on, though, and this is certainly something that will become more important after the midterm elections, I think, is whether the Republicans start to pivot now towards entitlement reform and start to focus on the deficits. Because so far what you haven't seen is a lot of the fiscal conservatives on the Republican side haven't necessarily been in the vanguard right now.
Mike, let me make a quick,
seen that.
Let's make a quick prediction. The Republicans will get off their backsides and do something about the debt and the deficit when the 10-year yield is at 10% and the economy is flat on its back. I can't imagine if yields and interest rates, if Uncle Sam can still borrow at 4 or 5%.
They have no
and they were pretty
right
tough on it when there was a Democrat in the White House. I mean, they pushed really hard for spending, for pullback in spending, but when there was a Republican in the White House, they allowed the spending to go through.
Right.
Yeah, they did.